Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets, which again are hitting all-time highs. Ross takes a look at what's happening with gold, crude, the U.S. and Canadian dollars. He also thinks the grains, especially corn, are ready to pop. Publisher of the Leibovit VR newsletters, Mark Leibovit, joins us from Arizona to chat about whether the stock markets will continue into the stratosphere. He comments on the precious metals, lithium, Bitcoin, and real estate, and whether the U.S. government really has a stockpile of gold in Fort Knox. Editor of Cycles News and Views, Tim Cyclesman Wood, calls in from Gulf Shores, Alabama to take a look at how Dow theory is affecting the markets and what we can expect when it comes to interest rates. He also comments on whether the markets are manipulated. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be back. I take a week off, the market takes a breather, and here we are back at all-time highs again. So, at the beginning of July, the S&P was running in a stretch where it had 60 days of just positive upside action, and within that 60-day window, it was up 25%. A really unusual set of circumstances, and you invariably, at that point, will get a correction that will bring the RSI, and that's the RSI 9, it will bring it down to 40, and invariably, most of those instances produced a springboard signal for us. That's an oversold with our oscillators within an existing upside trend, and that happened right on the bell there on August the 1st. Usually that's an ABC style of correction, but not always. And in this case, that was the bottom of the move. We did make a new high about 2 weeks earlier into the middle of August, a correction until last week, and we've got a new springboard signal as of Thursday. So that's once again oversold with an existing uptrend. And the key now is that now produces a very good supporting low that we need to be monitoring. So Wednesday, Thursday of this week, definitely a point to be watching. And, Friday's got the action that you'd expect out of Jackson Hole with Powell leaning towards possible rate cut. With that, we've got a really good bond market and you've got a good equity market. So, on the good news, markets are rallying, but the key is always, is there sustainability to that? And rather than pick a top, the idea will be to monitor the supporting lows and see that those manage to stay in place.
What's going on with gold?
Gold's stuck in the same trading range since April the 21st when we got our upside exhaustion signal. So that's 88 days here in this consolidation. Typically, long periods of consolidation for gold will run about 60 to 65 days. The ones that stretch beyond that, like this one, can take well through 100 days. So we're in this really tight range. There's not much to read into it. We did have some short-term oversold signals around the 30th of July. But the pop really wasn't of any magnitude. It still is putting in consecutively lower highs. while we do put in consecutively higher lows starting from the early part of April right through. We've got, let's see, the April low. You've got 1, 2, 3, 4 consecutively higher lows in place here. And considering the action that we've seen in the U.S. dollar, it's surprising that gold hasn't managed to break out on the upside. Now, contrary to that, we've got the silver market, which did put in an April high, but has been putting in consecutively higher highs. And as of today, cash market hit $39 for the second time on this move. The first time was back at the end of June, and we had some good oversold lows against the 50-day moving average during the end of July and the 1st of August. That was around 36.5. So silver market's got a really decent upside bias to it. And as you know, our modeling has next year to be a major cycle high. So, you know, that has clearly had projections of anywhere from $50 plus. So we'll see how it unfolds. The miners, we take a look at the GDX, the GDXJ. So those are the gold ETFs, or the SILV or SILJ, which are the silver miners. They are making new highs for the move, so there's good leadership as far as the stocks are concerned. Even platinum, which had a big correction and had a good oversold low here about 3 weeks ago, is coming back decently. So precious metals, upside bias right now, with the leadership being in silver.
Anything happening with crude?
Crude oil, we are just easing off here. We're at 72 and change as of today, and I don't think that there's much to read into this as of yet. I'm really hoping that we can put in a good, solid break. I'm pricing at 63.5 right now. I got that one wrong. 63.5, and so it's a small uptick in the latter part of this week, but overall, trend has been easing down since the bombing on Iran, and we'll look for, who knows, maybe a good oversold low to give us some indications of a trade, but for now, it's just basically a flat market.
What's going on with the greenback and the loonie?
The U.S. dollar was doing really well up until today, and as we're getting the statements out of Jackson Hole, the U.S. dollar has taken it on the nose. We're back to the low levels that we saw, lowest actually levels in about 5 or 6 weeks, trading at 97.5 on the index. Had been looking for this to possibly rally through to get to 100 102, but as I say, the catalyst here has been Jackson Hole. The important levels to watch for are just right here at this 97.5, and we'll see how it holds. And considering how much of a break there's been in the dollar index, that tells us that gold really is not ready to break out. It should have done it on a relative basis today, but looks as though that's not in the offing.
Is there anything else we should be keeping a close eye on? Something corny?
Corny. Well, we've got some indicators that are starting to kick in here in the grains, and more particularly in the corn market, which had we have setups that work their way towards buy signals on the weekly charts. And about 4 or 5 weeks ago, one of those then came to a conclusion. The type of thing that precedes a low can be up to a month, but it's a major signal. And then in the last 2 weeks, we've got a sequential 9, so that's 9 consecutive weeks with closes on the downside. And now that we've got that coupled with this other cancellation sequential on the downside, that matches only 7 examples all the way back to 1970. And once we see an upside reversal here, and it looks as though we're just on the verge of that, then we should be looking at a multi-week rally. So, for all that we generally keep our eye on the financial side of things, the agricultural side does present opportunities. And in this case, it's corn. So there's both the futures contracts and the ETF that can provide the opportunity for a pretty decent trade.
Ross, thank you so much for being on This Week in Money.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Mark Leibovit, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRtrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money.
Glad to be here, Jim.
Can you tell us a bit about the VR Trader newsletters and how our listeners can subscribe?
Sure. Go to VRtrader.com. That's V as in Victor, R as in Robert, Trader.com. And it's a shortcut to Leibovit VR newsletters. And if you go there, you'll see a whole bunch of newsletters up on the home page. And we cover most of the major markets. We have several letters, but, in recent months, actually last couple of years, the crypto area has been hot. So we have we've had this for a number of years, the blockchain letter. Then we have the metal resource letter for energy and metals and so forth. And we have a market timing letter. And the main letter that I would encourage people to look at is the VR Platinum letter. Not related to platinum itself, it's just the name of it, but it covers all the major markets. So we've been doing this in one form or another since 1979, believe it or not. So we've been fortunate to have been ranked top market timers, and we tend to trade a little bit and enjoy the action in the markets. But it's technically oriented with a cyclical underpinning. So again, it's at VRtrader.com. Thank you.
The Dow, the S&P 500, and NASDAQ hit new all-time highs last week. Are more new highs likely ahead?
I think so. The sentiment was really bearish, in recent weeks, which is sort of funny since the markets had been doing well after that shakeout in April, sort of shook up people a little bit. But today, Jay Powell, who's not my favorite person, but I'm sure he's a nice guy, was at Jackson Hole, Wyoming, which is one of my favorite places. And, his comments at Jackson Hole, though it was not an official lowering of interest rates, that's the Fed fund rate that he deals with, not the Treasury bond rate or the long-term rates. But, his indication was, and of course there's a couple board members on the Fed that have been voting against the holding of rates high. They were encouraging it to go down. A lot of political pressure. I'm sure our listeners know about it. Donald Trump wanted to fire Jay Powell and replace him with someone else who's going to be replaced anyway because his term ends next year or next summer. But his comments today, hinted that, the rate cuts are coming. We all sort of knew that. If you check the CNN, there's a sentiment reading that's published every day on, bullish, bearish on the market, and there's also a sentiment reading that I think Bloomberg does on the probabilities of an interest rate cut. I think it was like a 90% optimistic rate that there was going to be a September rate cut anyway. So I don't know why today suddenly the market exploded, which is, the Dow was up nearly 1,000 points at one point, and then closed up over 800. And new highs, as you just said. And, my model that I put out, a forecast model every year, it's one of the products that's on the homepage at VRtrader.com. It's called the VR Forecaster, which I did mention a moment ago. We put out at the beginning of the year, it's sort of a cyclical picture for the market. And it, pretty much presented a bullish case before 2025. And, the issue short term for the bears is, the cyclical picture during, September, October. Are we going to see, the rate decrease and then suddenly the good news is out and the market sells off? In other words, are we going to get the seasonal sell-off that so many people expect? And it's sort of funny because sometimes the news, justifies the cycles. In other words, you see a cycle coming, all the news is good, and the cycle is negative, and you say, well, it's not working, and then suddenly some bad news hits, and all of a sudden the cycle is working. So, I wouldn't dismiss the historical seasonal pattern, which, has reasonable accuracy, but nothing is 100% that during September, October, you could get a correction. So maybe we shoot up for a while, and then we go, suddenly there's some bad news, economic news or geopolitical news or something hits, and suddenly you get the September, October sell-off, and then it rallies into the end of the year, which is the normal pattern. So, it depends if you're trading or you're taking a longer-term view. The longer-term view is we're going, I still think, higher. So the question is, will we have that shakeout coming in the next month or two, despite what happened today? So I'm trying to remain bullish because, everybody's sort of been anxious, worrying about tariffs, worrying about whether the Fed was going to lower rates, whether the Treasury bond market was going to accommodate it or not, continued fear of inflation, and so forth and so on, geopolitical issues, what's going to happen with Putin and Ukraine, what's going to happen with Middle East, what's going to happen with North Korea and China, on and on and on. So there's always that wall of worry issue that, Joe Granville wrote about decades ago that is part and parcel to it. So I have a target in the S&P around 6,500. My next target is 7,400, nearly 1,000 points higher than where it is now. So how we get there with a bunch of zigs and zags or straight up there is a tough call. But I'm trying to remain as positive as I can because I still think cycles, my cyclical work says, okay, what's going to happen in 2026 until we create next year's model? That I can't say. Maybe we have an explosive year and then next year is a corrective year. Tough to tell, so we'll just have to, as we do every day, take it a day at a time.
Fed Chair Jerome Powell versus President Trump. Could the end of the Fed be around the corner?
I hope that's the case. I've been writing about that for decades, Jim, and it's not my original thinking. There's a famous book, which I highlight in my newsletter every day, G.W. Griffith's classic book, The Creature from Jekyll Island, which is where the Jekyll Island location where the Federal Reserve was created back in 1913. And there's so much, secretive activity and stuff going on there, things that are not talked about. There hasn't really been a full Fed audit. Several U.S. congressmen and senators have initiated bills that went nowhere to discard the Fed altogether and, create some serious audits of their activity. I think eventually it could happen. So we'll see. It's, the pressure is to end the Fed, but I don't think it's going to happen so quick. It's almost like the story that I've been writing about and we've talked about on these interviews about whether there's gold in Fort Knox or not. You're not going to get the audit, even though everybody's pushing for it because the gold's not really there, in my opinion. So there's things they just have to cover up. And the Fed, unfortunately, which is really, an independent agency, it was created by the government, but it runs as a separate private corporation. People that are hired there are not paid by the U.S. government at all. They're paid by the private corporation. So it's sort of a little secretive environment over there. They do some really nutty stuff, like lending money to or financing Harley-Davidson stock or bonds years ago, getting involved in things that they don't talk about publicly. A lot of hocus pocus over there at the Fed, and there's also a lot of controversy about how they manage money over there, the money supply versus the interest rates. The most classic statement I think we heard in recent decades was when Ben Bernanke, one of the former Feds, if you may recall, the Fed, I think it was 2008, 2009 time frame, was interviewed on CBS News, and they asked him directly, "Do you guys print money?" And, he hesitated for a second and said, "Yeah, we do. We have a little button we push, and we start printing money. So when you think about the legitimacy of the Fed and its real purpose and what it's all about, and we talked about our money supply, we talked about collecting taxes from people and all this kind of stuff, but the Fed can just go ahead and print money. What does that really mean? You know, it depreciates the value of the currency on one sense, and demeans the whole purpose of the Fed. So it just really an unusual institution. I think the creature from Jekyll Island is correct in trying to point to the fact that it's sort of an illegitimate entity. Going way back in U.S. history, Andrew Jackson, for those who are familiar with him, in the 1840s, he actually abolished the National Bank, which was the equivalent of the Federal Reserve back then. And so we ended up creating a new one. We were able to operate for many years without it. I think the free market's the places to determine interest rates and flow of capital domestically and internationally, not a central bank. And all the central banks in the world sort of follow or mirror the Fed in one form or another. And the influence is just too, overwhelming and not necessarily positive. The track record of the Fed has been horrible. It's responsible for many recessions. And in fact, the classic statement that actually Ben Bernanke made back in that 2008 interview, Jim, was, I think he came out with a phrase, something to the effect, "Yes, we caused it, and I'm sorry," referring to the fact that the Fed helped precipitate the Great Depression in one form by actually raising interest rates during that period of time. So the track record has been horrible. The economists that are advising it are getting data which is probably incorrect anyway, and economists are very bad in forecasting markets and the economy. That's historically correct. So my answer is it should go. I don't know whether I don't think Trump will be successful at it. I hope he is, but it's not happening this year, I don't think, for sure. Probably happen. Well, if he's looking for a new Fed chairman next summer and sort of follows Trump's, interests, which is probably more gold related to the backing of the currency and more flexibility on interest rates, is probably less pressure, at least from him, to disband it. So it's going to be put on hold for a while, to answer your question, but I think it should happen.
The U.S. dollar's been in a trading range the past few months. Are there bullish and bearish cases for the U.S. dollar going forward?
There are. I'm sort of neutral on the dollar because we tie other markets to it, and sometimes these markets don't cooperate. If the U.S. dollar is weak or strong, we started attributing movements in crude oil and gold and commodities to it, and external pressures and events could override that. So I'm not in the camp that the dollar is going the way of the dodo so fast as many believe, particularly with the BRICS nations attempt to discredit it. And it trades back and forth. My own feeling is, that a strong dollar is really what Trump would like to see, bringing business and authority back into the U.S. economic sphere. But I have no real conviction on the dollar because we focus too much on whether it's being up or down and what it means in terms of our business and the effects on other markets. And we found, despite a correction in the dollar this year, stock market did well. And, that sort of flies in the face of those who are saying the opposite. So I don't pay much attention to the dollar on a trading basis day to day. It might have some effect, but I'm sort of neutral, so I really don't have much comment on the direction.
Platinum and palladium have pulled back after topping in July. Are these likely short-term or long-term tops?
Short-term top. I mean, they are so far behind. Metals are catching up. That's the truth, and we've known this for a while. I mean, platinum used to be more expensive than gold, and it's nowhere near that level. It's like a third of the price of gold. Palladium was way behind. They both had nice bounces. Silver is showing some strength. The whole metals resource sector is generating buying interest because we need these products. We need these metals. We need it for expansion, for our energy, for our economy. So there are buys. Any pullback, I think, in platinum and palladium, we have them on our recommended list. They're cheap compared to historical prices. So I'm bullish. I think there's more to run.
Gold topped in April and has since traded sideways within a range. What do you see ahead for gold?
Gold has moved too far too fast. I'm still a bull, but, you could get, we've talked about this, you can get a correction. I think the gold shares are doing better. Names like Newmont Mining, Agnico Eagle, some of the gold shares are starting to catch up, rally to new highs. And even if gold just sort of stays where it is, so the play is more in the shares, which is, I guess, really they were underperforming for the longest time, and now they're catching up. So I think it's more a focus on what gold stocks you want to be in than gold itself. As far as if gold's going to drop, sure, at some point it could have a shakeout of a couple $100 or more. I mean, there's some studies I've seen saying the fair value of gold is probably around $2,800, and it's around $3,350. And whether it goes to fair value or whether it stays here is just a debating point. But I think with the push on the part of the Trump administration to get gold more involved, both in the crypto market and in the treasury market in terms of backing it and the possible revaluing and repricing of gold itself, you got to remain a bull. I think the wind is at its back. If there is a couple $100 correction, I would say it's just an added opportunity. But as I mentioned a moment ago, I think at least recently the play is more in the shares.
Silver put in a high in July. Is the silver bull likely to continue?
Yes, doing well. So the silver stocks are doing well, more than the metal, though the metal is moving up as well. We have positions in the indexes that follow the silver shares, and they're moving higher. Silver is this is like asking the question about palladium and platinum or lithium or uranium or rare earths or any of the metal sectors or the resource sector. It's a catch-up play with silver, and just a matter of time until it breaks well into the $40 an ounce level and ultimately through the record at $50. And it's just a matter of time. You got to be diversified. You can't be sitting around every day waiting for silver. Although I know people that have done that. So I'm bullish, and the shares have been acting okay. And it's just a fact in terms of the way they've been trading in recent months and years. So it's a catch-up play, but it's also a serious demand on the part of world industry and commerce that they need these metals. So I guess until we start mining the asteroids, which supposedly have infinite supplies of rare earths and silver and gold and all the metals we need, we have to find it here on Earth, and there's not an infinite supply. So, and we know what's going on with China with the rare earths. They control 80 or 90% of the supply there, and we're in desperate need of that. That's going to keep pressure on prices for the rare earths. Space program, atomic energy, expansion of our energy needs. All these metals, including silver and others, and copper are part and parcel to the program. So, for the time being, I'm staying in the bull camp.
Crude's been pulling back. President Trump has been and is in the process of ending wars. Is that bearish for crude?
I've been bearish on crude for over a year. I've been looking possibly first of a target, which I think you remember, and it was successful predicting when it was in the 70s. It moved to the mid-50s, and we got to 55, and I have an alternate target as low as 47. Crude's been bouncing here a little bit the last couple days. Just what the charts say, and maybe it's a drill baby drill effect on the part of Trump, but it's also with what OPEC has decided to do. And of course, you can argue, well, suddenly the Straits of Hormuz are closed, or suddenly war accelerates, and yes, at that point there could be some blip, and you'd have to trade accordingly. But I think the trend is pretty much down for now. Maybe next year or year after things are going to change. I think it's more of a Trump effect right now, so I would stay cautious on. Now, some of the shares are not doing badly. Some of the big name oil stocks, because they pay good dividends, and the oil companies themselves have been successful in making money. Even with crude at current prices. Even at $60, $65 a barrel, they're still making money. So the shares with their dividends still may be decent plays, and many of them are in the stock indexes, and they move with the indexes. But crude itself, overall, I still think it has some downside risk.
Is the lithium market heating up?
Yes, a couple of hot lithium stocks we've had on the list have been upticking. You wonder why, because you think that, with the tax credits not going to be available to companies like Tesla in September or going forward, I think this would put pressure on it. But we still need lithium for the cars. There's still demand for the EVs, particularly now with Tesla pushing for the automated driving program. Big companies like Uber and others want to have the robo driving, and many of these cars are going to be lithium-based vehicles. And a lot of demand coming out of China. China's producing a lot of lithium-based automobiles too. So I'm in the camp that you shouldn't be forced to buy one if you don't want one or can't afford it. But they have been upticking. So I'm surprised, because with this tax credit issue having come up, you would think it would be the end of it for a while. But no, it's still in demand. So I'm still positive.
Bitcoin hit a new all-time high last week of just under $125,000. It hit a high of just over 123 in July. Could Bitcoin have put in a double top?
Well, it looked like it. It got down to 112 a couple times, and then it bounced today. I'm still looking for the mid-140s, and ultimately much higher than that. Everything runs in cycles. You can have a big run here by the end of the year, like in the stock market is having now, and Bitcoin runs into 150 or 140 and takes out that little double top you just mentioned, and then next year collapses back to 90,000 or something crazy like that, because there's this volatility in that market. We've seen it, in Bitcoin for the last, got to be 15 years now. So, bullish still. Ethereum has been catching up, which is, the sister crypto, as most of you are aware, and that looks like it's got higher targets. And XRP, one of our other favorites, has been doing better. It's been trading around the $3 level. But, I don't want to say it, can never happen, because we've seen it already where suddenly there's a big washout in Bitcoin and everybody gets bearish. And, as a trader, I would be concerned if it broke under 100,000, and then we'd have to watch it from there. But, there's too many big players in that market, most noteworthy of which is BlackRock, which is Larry Fink's company, which is the largest money management company in the world. And they helped create the ETF for Bitcoin in March of 2024. And that's huge underlying demand by institutions and investors by having an ETF for Bitcoin. So, like I say, nothing goes up forever, but the trend is your friend here. You've got the U.S. government under Trump's pressure. We've created these various acts, the Genius Act and others, to help support the crypto market. And we have, the Bitcoin Reserve being created on the governmental level. So like I say, you can always get shakeouts, but the trend is your friend here. So I'm going to remain positive. I still think a lot more is coming, and you got to take, a longer term view with Bitcoin, as we've seen here when it started at a couple $100 a coin back in 2000.
25 cents a coin.
Was it that cheap?
It was. It started off as 25 cents.
Well, you're smarter than me. I didn't see it till it was around 200-300.
Yeah.
Yeah, but anyway, yep. Look what it's done, and there's a reason for it. My biggest concern, and we had this in our interview, I think about a week ago. The risk to Bitcoin, and nobody's been able to figure out the programming for it. And there's speculation that with advanced computer power coming in the months and years ahead, these quantum computers and so forth, at some point could somebody break the code on Bitcoin? And if that happened, that could kill it. So that's worrisome. An explanation right now, and but I guess it's a potential reality out there that nothing is perfect, and if that code is ever broken, it probably would hurt it, and it would be a major shock to that market, and we can't predict that will happen at all or could happen now. So, but outside of that, they have the amount of Bitcoins part of the programming. I think it's every 4 years, maybe 6 years. I have to check the numbers. And supply is less. Big government support of it right now here in the U.S. And with the legislation behind stable coins and crypto, it's tough being bearish right now. So I'm going to remain bullish and hold our positions.
Well, just doing a little quick online research, the first ever recorded price of a Bitcoin was worth $0.003, and the first real world transaction for the purchase of goods, 2 pizzas for 10,000 Bitcoins in July 18th, 2010. So yeah. I think you can get more than 2 pizzas now for 10,000 Bitcoin.
I think so. It's amazing that it was being used and people were smart enough to transact at that time with it, I haven't done personally any transactions in Bitcoin. I track the ETF and the basic commodity itself. But, there's been Bitcoin machines everywhere. We can buy and sell Bitcoin, and big companies out there with huge computer power out there daily trying to mine. It's called mining the market, and trying to pull Bitcoins out of the Ethernet, so to speak. So it's amazing what's really happened. Yeah.
Is Bitcoin becoming a higher risk investment?
One of the reasons I didn't get involved in it when it was that cheap, and in hindsight I was happy I didn't. There was a platform. You remember the story? It was called Mt. Gox, and it was based out in Japan. And that was one of the platforms way back in 2010, 11, 12, where you could actually buy the Bitcoin. We didn't have Coinbase and, many of the other platforms that are out there right now. So it turns out that, that platform went bankrupt. The people who had their coins held there got wiped out. Now, I haven't been on top of this for the last year or so, but there's apparently bankruptcy actions in effect, and there's been some effort to try to restore the lost money. But when Mt. Gox went down, and this again, I think it was before, 2015, 2016, somewhere in that time frame, I just lost interest because where was it safe to buy and hold the Bitcoin? Now you've got the bigger platforms, and people see there's still risk there that they could be, compromised with programming and hacking and so forth, but the risks are more minimal now than they were, back then. So after that Mt. Gox experience, so that's been sort of my excuse why I didn't jump in bigger, because I was afraid that would the platform be safe to hold it. Now you've got the ETFs, which are safe, the exchange-traded funds, many of them, and the government behind it. So it's a little different story today, but markets do move, and like I was speculating a moment ago, if some programming is ever created that could break the code, that could be risk to the Bitcoin. I remember there's plenty of other cryptos out there. You got Ethereum, and you go down the list, there's probably 1,000 names out there of ways to participate in the crypto market. And one of the safest places to be would be in an ETF. And there's actually some funds now that hold several of the cryptos as part of their portfolio. So your risk is diversified versus it being only in Bitcoin. So you might want to check those out. But I think I answered your question, and I'm not sure.
How are new cryptocurrencies created, and are there big payoffs for the creators of cryptos?
There are. I'm not an expert at this, but they're created by launching entirely new blockchains. Forking an existing blockchain to create a new one from its code, or creating tokens on an existing blockchain platform. And it's complicated. It involves designing cryptocurrencies characteristics such as the total supply and consensus mechanism, and then deploying it on the network. Some cryptos are also generated through mining, but creating a new, crypto using the blockchain is complex, but it is done, and it's not something I'd recommend the average person do. But there have been some success stories with people creating new cryptos, but you got some pretty stiff competition out there now with the names already out there, so wouldn't be my first choice.
Home sales continue to slow in Canada and the U.S., and prices are starting to drop in a number of markets. Do you think the financial powers that be would crash the real estate markets to make President Trump look bad?
Oh, boy. That's the old, conspiracy theory about the markets. And, yes, markets are manipulated, but And, there's a shortage of supply in the real estate market because of the cost of building and the supply chain issues. And prices have been high, so that's discouraged a lot of small new home buyers. But at least here in the interest rates, I think I read today that mortgage rates have dropped a little bit, somewhere in the 6% plus area. And I get a lot of emails almost daily from many of the home builders that are offering unbelievably low rates because they buy down the rates as incentive for new home buyers to come in. I got an email, and I don't want to mention the name, but there's 2 or 3 of them. They're national names. We can get in for like 2%, but it's 2.5% on a mortgage, but then it's 3.5% next year and 4% the year next. So you have a laddered interest rate thing, but an incentive to get you in really cheap now. So with the home builders buying down the rates, I think this is going to help the market, and it's going to turn, and you're going to see. And if you look at the shares, I'll give you an example. There's an ETF called NAIL, N-A-I-L, which represents many of the home building contracting companies, and the stock way down, from a couple $100 a share to $30. It's rallied up almost to 90 in the last couple of weeks. And one of the big stories the last 3 or 4 days is Home Depot, which has had a big rally. And there's also the ETFs for home builders. ITB, I think, is the symbol. And these have been rallying in anticipation of increased sales. So the market's telling you it's coming. Prices are going to come down, or business is going to go up. And the combination of various factors, whether it's the home builders buying down rates or rates coming down themselves, or just, demand coming back on the part of consumers because of a, better economy. So the stocks are telling you home sales are going to go up. So I'm bullish.
What are you hearing on Russia, Ukraine, and do the markets seem to care?
We could spend an hour just on the Russia-Ukraine story. I have a whole article that I put in my newsletter about, unfortunately, how the U.S. was responsible for a lot of the Ukrainian problems that we now have. And it's better reading that and checking with my newsletter occasionally than to get into it. Everybody's pointing fingers to Putin, but he's not only to blame, because apparently the history says the U.S. was the culprit in many ways. Putin was lied to. He was misrepresented on whether NATO was going to be at his next door, where he was told it would not be, and then we lied and changed our opinion on it, and this is going back to previous U.S. administrations. So in a way, I'm sort of sympathetic to Putin because he was lied to, and I think at one point he was trying to be more cooperative about the whole situation. So, and then Zelensky is a work of art himself. This guy is a crook, and there's been stories that he's moving money out of Ukraine into other markets. He probably knows his time is coming. He's not going to be around forever. And we had all those scandals with Biden and Ukraine, as you know, in recent years. So I'm not quite sure how it's all going to resolve because we have a lot of bad actors on both sides, and it has to be resolved at some point. So hopefully, the Europeans and Zelensky and Putin, everybody in the U.S. are all in agreement, but I don't think Russia's going to give up the lands that they feel that they're entitled to. So it may last a while. It may not be settled for a while. We'll just have to wait and see. So I'm not on Zelensky's side by any stretch, and I'm not on the U.S. side totally by any stretch either. So we just have to wait and see how it plays out.
Got to keep this one alive. Still waiting for the Fort Knox audit to see if it really has all the gold the U.S. claims it has.
Not going to happen. Too many heads would roll if we found out that gold was not there. There are places gold's being stored, like West Point and the New York Fed and other places. But the fact that we haven't opened the doors and embraced an audit since the 1970s tells you there's something rotten in Denmark. So, this is like saying the JFK assassination or the Epstein cover-up or alien bases on the moon and what the astronauts saw when they were up there, what they didn't see, and the whole UFO cover-up that's been going on for 70 years. I mean, it's all part of government cover-up, quote-unquote, conspiracy stuff, and Fort Knox is part of that, unfortunately. So, they could do is ship a lot of gold into Fort Knox, some other locations, and make it look good at some point to quiet things down. But outside of that, I think, it's been leased and subleased and lent and or just sold over the decades. And it all started when Nixon took us off the gold standard in 1971, and that's when the shenanigans started. So the fact that it's not there, in my opinion, otherwise we've been shown it a long time ago, is a great support factor for gold itself. And it says over time gold will go higher because unless we start, as I mentioned a moment ago, regarding to general metals, if we start mining the asteroids and start bringing gold in, and who knows, they already may be mining in asteroids and they're not telling us, since the government keeps so many of their, space activity secret. If that's not happening, there is a shortage of gold and it should go up. So anyway, I'm not holding my breath for a legitimate audit. Let's just put it that way.
2 eclipses are coming up in September. The first one, September 7th, a total lunar eclipse during a full moon, a corn moon. The second one, September 21st, a partial solar eclipse. 2 eclipses in 1 month. Could that rock some markets?
Mom, as you know, I'm very attuned to the cyclical events. I find, over the decades, there is a correlation. We've got the seasonal autumnal equinox, coming on September 22nd, 23rd, and that's where one of the partial solar eclipses is occurring. We have, our lunar cycles that I follow pretty much day to day in terms of any, change point in the markets. We just had a lunar cycle the last couple of days. So a lot of activity out there. There was a story that we put in our newsletter, which we talked about, I think it was last week. And, I like to talk to you about it, if I can, about the effect of the solar flares, on the human being itself. So we've had whole study came out in Space Weather. I'm trying to pull it up here, as we referred to it last week, try to summarize it as best I can for you while I'm on the air here. The story was essentially, let me just pull it up here. We're talking about the effect of cycles and all this cool stuff. So the question was, do geomagnetic storms on the planet affect human blood pressure? Oh, yeah. We're talking about the effect of the eclipses and the lunar cycles and the seasonal cycles, like the seasonal cycle, the autumnal equinox and the vernal equinox and so forth, and the solstices. So there was a study done in China that analyzed more than 500,000 blood pressure readings taken over 6 years, and it tied to geomagnetic activity. And they say the blood pressure rises and falls with rhythms in the magnetic unrest on the sun. So, we talk about how human beings are 90 or 98% or whatever it is water, and how the lunar cycles and the moon can affect us, and we see hospital emergency rooms full of people during full moon. So when you ask me about the eclipse, and when you ask me about the seasonal cycles, and you ask me about the solar activity, we are affected. And there's just not, very much discussion about it, because it doesn't fit, the normal parameters of our day-to-day existence, that we're in control of everything. So there's a new moon right now, in fact, on the 22nd today. Just to let you know, and we had this big move in the market today to the upside. So there's some tie-in there why that suddenly happened today. And then we've got a full moon on September 7th coming up, and the autumnal equinox, as I just mentioned, on the 23rd. And there's, other interesting things happening out there. There's a little, I guess you call a small mini planet. There's a whole bunch of them in our solar system. And I sort of highlighted this in our newsletter this week. It's not something, you call them dwarf planets. They're not officially recognized. I'm here in Lowell, the Lowell Observatory area in Flagstaff, Arizona. This is where Pluto was discovered back in the 1930s. Percival Lowell, the guy behind the observatory, was more interested in Mars and the canals on Mars, which really didn't exist. But so you've got these dwarf planets out there. And there was some comment about, there's one of them called Sirius. It's one of the dwarf planets. I'm trying to locate the exact location for it. It's in my newsletter, the exact spot. It's located in the asteroid belt between the orbits of Mars and Jupiter. So it's another little planet. You don't hear much talk about. There's some others out there. There's one called Makemake, Haumea, there's Pluto, there's Eris. There's a bunch of these little dwarf planets out there. And apparently some have tied some cyclical activity to these. And Ceres is not generally recognized as a celestial body. But so anyway, it resides in the asteroid belt. And as I mentioned, it's located between Mars and Jupiter. And it was named after the Roman goddess of agriculture, of the harvest. And it should not come as a shock those who are trading, particularly those in the grain futures, to see there's a correlation between the grain markets and the movements of this little dwarf planet Ceres. I know this sounds totally far out, but there is research beyond that when it changes direction, and somewhat much as you can point changes of direction to lunar cycles and seasonal patterns, it's something about this little dwarf planet and its effect on agriculture here on Earth. So they say some of the analysis that I've read on it, and there's some other experts that are greater than this, they say the sharp rally in soybean prices last week pretty much was tied to this movement in this dwarf planet and its location. And again, this just doesn't make sense to the average person. How is this possible? I mean, only weather controls stuff here on Earth. That external forces like the sun or the moon or dwarf planets or cosmic forces can't possibly have effect on us. And there's some research pointing to that as well. So got off a little bit of a tangent here, but I found this is amazing research. And if you ask the average person, name the dwarf planets in our solar system, you'll probably immediately get a giant question mark on their face that none would even know they existed. And apparently there is some correlation in their movements and cycles. So it's really fun stuff, because it's not something you hear on the financial news or is generally discussed, because it's something we just have no control of. We can't believe that we possibly are affected in ways beyond our control. So I've been a student of this for decades in one form or another, just following some of these cycles, learning every day it's about a new one. And just like this one I just read you about the geocosmic effects of solar activity on human blood pressure, among other things, is just amazing stuff. It only makes sense. The power of the sun and what it could do. We saw what it did in the Carrington effect back in the 19th century, solar flares. I mean, there's been historical accounts among geologists that there was a flare probably 100,000 or more years ago. They were so intense that it just wiped out life on the Earth, or a good part of life. And there was these remnants that they call it's like a black ash that they've uncovered at subterranean levels, that they see it around the world at a time when such a solar flare could have been so intense that the remnants are now represented by this ash that has been discovered. So, hopefully something like that doesn't happen in our lifetime, but the sun's there and the power exists. So anyway, fun stuff. Right now, we'll just watch to see what happens in September with these short-term cycles. But generally, you get a change of direction around these cycle points. It's something to watch for.
Do you think good is defeating evil, or is evil still winning?
Let's hope that good is defeating evil. I'm a religious person, and I'm on the side of good. And I do my prayers every day, and I believe good is winning. That's my opinion. Remain a positive. God is on our side.
President Trump was able to clean up Washington, D.C., the city, not the political swamp, in 4 days. Is this likely a template for cleaning up the rest of the U.S.?
I sure hope so, particularly in many of the cities that are housing illegals, the refugees, and so forth. It's a big problem. I think it is a model, and we have a problem, and mainly because of the administrations that have been running these cities and states that are just so liberally oriented that it's affected their mental state to the effect that they don't accept reasonable facts or do reasonable things. There's an expression that was created by an author contact that I read his books all the time, Michael Savage. He's got a little radio show now on actually a TV show on Newsmax. He used to have a radio show for decades, but he wrote a book got to be more than 10 years ago. It might be 15 years ago, called Liberalism is a Mental Disorder. And I know that offends some of our liberals out there that are listening to this, but he documents it, and you can see it in the actions of the Democratic Party and the way some of these cities and states are run here in the U.S. and even in Canada, and ignoring real facts, ignoring the reality. And I guess the most classic example was opening the borders here in the U.S., where no other country or government would allow that. We did, and that was a liberal action. So I'm very much a believer in Michael's book and his idea, and I think it's created a mental state, unfortunately, among people, and they ignore facts and they go with their emotions and their mental state versus objective reality of what's best for business and for the country. So anyway, that's my response.
Where can our listeners follow you and subscribe to your newsletter?
Well, if they like the kind of stuff that you're hearing on this interview, you're going to get it at vrtrader.com. Some of my friends say, well, why don't you just stick with, a stock price going up and down and just forget all the geocosmic or political comments and so forth. But there's a connection with all of these, and they all are tied together. And most financial reporters just don't touch it. They don't want to. The first thing you'll hear them say is, well, I'm going to make this comment. I'm not political, but I'm going to make this comment anyway. Everything is political. It is a connection to the economy and the way things are run. So, and when you talk about cycles, they don't want to talk about a lunar cycle or a solar eclipse, or a seasonal pattern in the market, because that's something they can't see on a balance sheet or control in any way, shape, or form. So they dismiss that. So you're going to get that at vrtrader.com. So if this kind of stuff interests you, this is the place to go. And I enjoy writing about it, and it's part of my life, and been doing it for a long time. So vrtrader.com is where you go, and you can subscribe to any number of our newsletters, and appreciate you mentioning it.
Mark, thank you so much for being on This Week in Money.
It's been a pleasure. Thanks for having me.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was speaking to us from Arizona. Coming up, Tim Cyclesman Wood, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. He's speaking to us from Gulf Shores, Alabama. Welcome back to This Week in Money.
Jim, thanks as always for having me.
Tim, can you tell us a little bit about Cycles News and Views?
Well, I don't call it a newsletter, it's a research letter, because it's, I think it goes above and beyond just a newsletter. It's based on cyclical statistical research, and I apply some quantitative methods. All cycles are. It's basically a means of trend quantification. If the cycle's moving up, then the trend is up, and if the cycle's moving down, the trend is down. And I look at cycles at various degrees. Long, super long, and then intermediate and short term, and developed indicators to help figure out when you're at or near some sort of a top, and of course in the long term, I think we're dealing with this ongoing bubble, but we'll get into that later, I guess. But anyway, it's like I said, it's a research letter based on quantitative analysis, and I've been tracking, and as long as this process has been, this has been quite the protracted affair, and I can get into that a little later as well. Mm-hmm. I have been guiding subscribers, I think, very well. We're seeing things just one by one, checking the boxes. The market has been moving higher. Things are falling in place with this longer term top and the developments around that top. So anyway, that's a little about Cycles News and Views, and the website cyclesman.com, and that analysis is all available through the monthly subscriptions. And then I do short updates in between, keeping people on track in between the monthly letters.
When's the next issue of Cycles News and Views due out, and where can our listeners subscribe to it?
I'm actually going to get it out this weekend, and it is available again at cyclesmen.com.
Tim, what is the checkmate chart?
The checkmate chart. Let me digress and get into some longer term stuff, and we'll come back to the checkmate chart. I don't know where to begin on this, but way back. Let's go back. Let me go back to 2000 first. With the peaking of the dot-com bubble in 2000, Jim, I knew, and I've maintained all along that was the organic top of the market. It was a long-term economic cycle. And, we never imagined, we know that since that low, if people just take a breath, clear your mind, and let's just think about this for a minute. Ever since that 2002 low, we all know, most of us are old enough to remember, we certainly should remember this, that, the Fed, it's all been about Fed monetary policy. And that's where the real intervention, I would say, began. And the reason for it is that they have been fighting the over-deflationary forces. And they've been doing it for 23 years now. With that said, let me take you further back in time. Since that 2002 low, and really since COVID, I have found what I think is a monumental discovery, and that is these long-term economic cycles. And what I found is that since basically the founding of this country, I have data back to 1800. Since 1800, there have been 6 long-term economic cycles. First cycle peaked in 1818, 1819 time frame and bottomed in the 1840s. And that cycle was driven largely by, thing of the country and land speculation and that sort of thing. So it had a sound economic underpinning. Like I said, that cycle bottomed in the 1840s. That cycle pushed up into around the Civil War, and then we had the crisis of 1873, and of course the decline into the next cycle. This second cycle, it peaked largely with the same underlying, economic conditions as the first cycle. It was centered around land speculation, settling of the country, but largely this time the railroad bubble. And, that took us down into the bottom of cycle 2 in 1890. And from there, the new cycle was again born, pushed up, this time peaking with the 1929 top. And this cycle was driven by the Industrial Revolution. Again, peaked with the 29 top. We all know about the Great Depression and decline into the 1932 low. And from there, the cycle started trying to turn up. It was driven then by World War II, and then, of course, the post-World War II recovery, economic expansion. That cycle pushed up into the 1966 bull market top, and then bottomed with the 1974 bear market bottom. From there, the cycle 5 was born, took us up into the dot-com bubble, into that top. And, of course, that was driven by, the tech era. It started in the 80s and then caught on fire really in the 90s and pushed us up into the dot-com bubble in 2000. And from there, cycle rolls over and declines into the 2002 low. Now, these first 3 cycles, when they turned down, they were quite catastrophic. They were wipeouts. They were bad declines. And there's some reasons why. I'll not get into that now. It gets too wordy. But the first 3 cycles were much more devastating when they turned down. The decline into the 74 low, it was no picnic at the time. Now we look back at it, nobody basically remembers it. I was a kid, and it's minimized. But it was a severe bear market. And of course, the dot-com bubble top, we've all forgotten about that one as well, but that was, pretty significant decline at the time. But the point is, they were all driven by with a sound economic underpinning. This cycle that began in 2002, like I said when we started, it's been based on monetary policy and liquidity. There's no sound economic underpinning. The economy is not as we've been told. The job numbers have not been, that's a farce. It's solely been driven on the speculative environment that we're in, and that's been driven on liquidity. Within the concept of this 6 long-term economic cycle, we had the peak in 2007 and the decline into the 2009 low. And I remind everybody that, that was dubbed the worst financial crisis since the Great Depression. That was quite the decline. But again, it was met with what? More intervention. Because what was happening, just like in 2000, that was where the deflationary forces were trying to turn the cycle down. And it's those deflationary forces that the Fed has been fighting since the 2002 low. And again, I want to reemphasize, that was the first attempted downturn into the 2009 low out of the 2007 top of the first attempted downturn out of the 6 long-term economic cycle. That aside, we get to the 2009 low. They're able to reinflate it. That's where we had the QE programs and all that stuff. We all remember that. And they pushed it up into the 2020 top. Well, there's many aspects of COVID, but one of which, from a financial perspective, is it was kind of a cover story for the peaking of and the second attempted downturn out of this 6 long-term economic cycle. And then look what happened. We saw more liquidity infusion. To the highest level we've ever seen. I mean, the debt, I don't have the chart in front of me, but, I think under the Trump administration coming out of COVID, there was like $8 trillion total added to the national debt in the wake of that. So it was a huge shot of liquidity surrounding that. And again, it goes back to something else I've said before. It's like Richard Russell said, an old technician years ago used to say, inflate or die. So they have to keep the system going. They have to have this constant infusion of liquidity and inflation. Inflate or die. And so that's what they did with COVID. Well, now we're sitting, and nobody knows this. Everybody thinks everything's okay. And we're sitting since the COVID low. We've seen, and of course, granted, that's been 5 years ago, but we've seen this. It's been fueled again on that liquidity, and now that's pretty much run its course. And we saw a little bit of a wake-up call, if you will, with the decline into the April lows. A little bit of a panic, kind of rustled the feathers a little bit. But now we've rallied back, and everybody thinks, well, okay, everything's fine. But in reality, what we're setting up for is the third attempted downturn out of this 6 long-term economic cycle. And there was a Dow theory primary bearish trend change, which nobody pays attention to Dow theory anymore, that was triggered back in March in conjunction with this decline into April. And that still remains intact. In spite of the new high. And without digressing too much on that, Richard Russell was the leading Dow theorist back in the, really from the 60s, 70s, 80s, all the way up into the, 2000 time frame. And I remember early 2000s, I remember Russell calling the primary bearish trend change in 1999. And we moved down into a low, kind of like we did in April. And then the industrials moved up into a final high in January of 2000. So it looked like, to a layman that didn't understand Dow theory, it looked like he was an idiot and he got it wrong. But in reality, Dow theory did its job, and it was warning And the Dow theory, it's kind of complicated. I'll keep it simple, but because the transports did not confirm that advance structurally, the Dow theory primary bearish trend change in 1999 held, and then you had this massive non-confirmation with the 2000 top, and it proved right. And that's the kind of thing, that's sort of the kind of thing that we've seen here. We saw the triggering of a primary bearish trend change that the industrials have recently moved to a new high, but the primary bearish trend change was not, the move was not confirmed by the transport, so therefore this primary bearish trend change remains intact. And then here we sit, like I said, based on lots of other factors. We're trying to set up for this third attempted downturn out of this long-term economic cycle. And the answer to your original question is, it's all those moving parts with this setup that the checkmate chart is a reflection of the setting up of the downturn for the long-term economic cycle, if I said that right. So the checkmate chart is a subset of this long-term economic cycle, showing us where we are in the progression of the events with the setting up of this third attempted downturn out of the long-term economic cycle.
The U.S. stock markets keep hitting new highs. What's the latest in Dow theory on that?
Well, like I said, Dow theory, we had the triggering of a primary bearish trend change, and in March, and in spite of the new high, the Dow theory primary bearish trend change remains intact. So that's kind of a stealth warning, again, that nobody is paying attention to, and it's part of this overall setup, this big picture, and the setting up for a third attempted downturn. Where is the U.S. dollar in its cycle? We are at or very near the 4-year cycle low. I think the 4-year cycle low is probably in place. I think it was seen in July. But if not, there may be one more little push down into the 4-year cycle low, maybe in the September timeframe. But until proven otherwise, I'm operating under the assumption that the 4-year cycle low has been seen in the dollar. Is the gold cycle usually the inverse of the U.S. dollar cycle? No, not. Yes and no. I mean, the degree of the relationship can vary. For example, yes, gold. You look at if you look at the advance in the dollar in the late 90s and early 2000s, for example, the dollar rallied. That's the standing high for the last 25 years. But and that's when gold made the low at $252. And from there, yes, the dollar has moved down and gold has moved up, etc. So there is somewhat of an inverse relationship, but the problem with looking at the relationship is you can't necessarily draw a conclusion as far as the exact magnitude or significance of that inverse relationship. In other words, just because the dollar, let's say the dollar goes up 10% or down 10%, you can't look at that and say, well, the gold is going to go up or down by, some multiple, because that inverse relationship has varied over time. Is the best way I know how to say it. But yes, generally speaking, there is an inverse relationship. Where is silver in its long-term cycle? It's the same as gold. Gold, there's the long-term dominant cycle in gold is a 9-year cycle. And, we had a long-term 9-year cycle low back in 22. So far, that long-term cycle is still intact. That advance is still intact. And silver pretty much moves by the same cyclical rhythm. So it's the same. There's no difference. Is there any reason why silver lags so far behind gold, though, before it makes a major move? I can't give you an answer to that. I don't have an answer for that. I think that, my experience, let me say this. Again, it goes back to looking at relationships. I think when you overlay charts, yes, you can see that there are relationships, and sometimes, like I said, the relationship is stronger in some cycles than others, and sometimes one commodity or one sector will lead or lag the other sector. So it's hard to draw any real conclusions about that. But yes, the short answer is they move to the same cyclical rhythm. Do you think President Trump will get the lower interest rates he wants? I think he will get them, yes. I don't think that he's going to dictate them. This is if you want to talk about that for a minute, that's a bit of a political football. I have proven time and again that interest rates, the Fed follows the short-term T-bill. I have a model. It's ironclad. You can look at it in a form of a chart. You can look at it in the form of in a spreadsheet and line the numbers up and look at it. The Fed follows the short-term T-bill, and they're not going to. They can influence. Let me back up for a minute. They can influence the short end. They can jawbone, and they can influence the market, and that's what they do. It's one of the tools that the Fed has is they can sell the market on the idea that they won't higher rates or lower rates or whatever in the marketplace. We've all been conditioned, don't fight the Fed, and they can jawbone the market and push short-term rates around and get what they want, and that works until it doesn't work. But ultimately, the Fed follows the 3-month T-bill. And so if you look back in time, what this model shows is that every rate-cutting cycle, you go back in the pre-2009 era, the spread differential between the discount rate and the 3-month T-bill, after you got to the rate, after the rate hiking cycle had run its course and the rates had plateaued, and you get into the plateau period, that's another whole rim of identifying that. But once you get there, then what you would see before the Fed would cut is you would see the 3-month T-bill would have to move somewhere between 1 and typically closer to 2 points below the 3-month T-bill before the Fed would take action and cut. Well, then we rock on to the 2009 era and or 2007 top, and then in the post 2009 era, that spread narrowed. They become more aggressive, in other words. And so what we saw then, we started to see cuts at under a point, somewhere around 80 to 75 to 80, 90 basis points type thing. They would act. And then in the post-2009 world, or in the post, I should say, the post-2020 world with this last rate cutting cycle, what we have seen is that spread has narrowed even further. When they began cutting in 2020, the spread differential was very, very tight. And then with this last round of cuts, or this initiation, I say last round of cuts, this is just beginning. The first cut was last September. No, it was last July. No, it was last September, wasn't it? Yes, last September. And that was the most aggressive cut on record. With, in other words, the spread was tighter than it's ever been in the history of this data, which I have going back into the 50s. So that cut, even then I remember they were saying that the Fed had waited too long. Well, if you're looking at this model, no, they had not waited too long. They were right on. Actually, they were, like I said, they were more aggressive than any previous cut ever. And then we saw 2 additional cuts, and each of those were just as aggressive. One of them was more so. So the Fed has been very, very aggressive based on that spread differential in this round of cutting. After a rate cutting cycle begins, there is always this little pause period. Sometimes the pause period lasts a few months, sometimes a little longer. This has been a little bit longer of a pause period. It started the first of the year, rates flatlined, and the T-bill has been hovering somewhere around 1/4 point below the discount rate. And so that's too tight. It needs to get, like I said, based on the last couple of rate cutting cycles, and particularly this one, it needs to get somewhere around 50 to maybe 80 basis points below. We've been in the 25 basis point range. So they haven't cut for that reason. And I think we talked about it, or I mentioned it on a couple of shows ago, that until we saw that, I think I said, write it down, until we see 75, 80 basis point spread, they're not going to cut. And so where the political football comes in is I think that Trump is saying it's too late. He needs to cut. He needs to cut. He needs to cut. Well, hell, he's the Fed. I'm not defending the Fed. I'm not picking sides. I'm just telling you. I'm refereeing here. I'm telling you what I see. Until that spread widens, he has no reason to cut. And I think the way I see this being spun is as this checkmate chart sets up, if we start to see, weakness in the market, and then we are seeing the spread starting to widen now, the T-bill is starting to decline, and we're seeing it breaking down or starting to break down out of that pause period. So as it widens, I expect that's going to happen as the market weakens or begins to weaken. Maybe it occurs with the last push, into the top, but we're in that topping process, I think. Market turns down, and then the beauty of this, the political football part of it is then as the market weakens, Trump can point to Powell and say, "Hey, you didn't cut." Well, the reality is, again, he's following the model, and it wasn't time to cut. And so it's going to make it appear that, it's his fault that he didn't cut. And again, I'm not picking sides. I'm refereeing this. Will he get his cut? Absolutely. As soon as we see this spread widen, like I said, we see the 3-month T-bill dip into, I would say, somewhere between 375 to 4. We should start to see cuts, maybe a little lower, but 375 to 4 is where we've been seeing them in this, based on, the evidence with this, this current cycle. So as that T-bill weakens, yes, he's going to see a cut.
Is real estate in trouble?
I think all asset classes are going to be in trouble because if you look back at all of these long-term economic cycles, Jim, they are terribly deflationary. And, I mentioned the first attempted downturn out of this sixth long-term economic cycle was in 2007, 8, 9, that time frame. And that was quite devastating for real estate, particularly in my area. And COVID, the downturn, I think that was so quick and it was over. It really didn't have a chance to affect it. And the save job came so quick and with so much liquidity that it minimized it. But yes, I think that I absolutely believe that real estate is going to be in big trouble. Once the third downturn, the third attempted downturn out of this sixth long-term economic cycle bites, then the question is, can they save it? And if so, then okay, fine. But if they can't, then I think all asset classes are going to be in great trouble because it's going to be the unwinding, the deflationary forces. What that'll tell us if they can't save it is that the deflationary forces are going to take this market in most asset classes down. Yes.
Do you think markets are controlled and manipulated?
Oh, 100%. 100%. The other thing I have found in these studies is, you can look back. I have another thing I cover or have covered in one of the letters. If you look back at the debt creation, and there's so many things I could point to answer that question, but one of them is the level of acceleration. I ran some indicators. It was able to extract. You take the debt curve, and it was able to extract the acceleration points, running some rates of changes over it, and wrote some formulas, and you're able to see where the acceleration points are with the debt creation. And what you see is quite interesting. The acceleration points occur at most every major market turn or bottom. So, in other words, you'll see a market, a peak. It'll roll over into a low, and then just like COVID, the best example that everybody remembers, just like COVID, the market rolls over, and you see that liquidity injection in the form of debt. People say printing money. They're printing money. They're printing debt. And so, yes, you're getting that liquidity infusion into the market, but you're also getting the debt. And so you can see at every major market turn going back into, well, even into the 1974 bear market bottom. It's as far back as I have that data, but you can see where they step on the gas with the debt creation. So that's one way. So that the manipulation occurs. And then back in the COVID era, right after I say era, 2001, we saw the decline in interest rates, and the checkmate chart was trying to set up there. One of the components is short-term rates. And rates were trying to decline, and when you, in other words, it was trying to trigger a collapse from a much lower level with rates at zero. This thing was trying to come unwound, and they had to do something. And that's when some of us will remember this, but I certainly remember. I watched it as it happened. But we get into early 2000 or 2021. And remember when everybody was talking about the reverse repo operations. And to the day, as short-term rates moved back and was at a critical point of breaking down and triggering, a bigger problem, we started to see those reverse repo operations. They step on the gas. And those reverse repo operations, I'm not an expert at Fed operations or anything like that, but I can see it in the chart. And what they do is they were able to put a floor under the short-term rates and get rates up. And if you also remember, they were jawboning at that time about the inflation, supply chain shortages, which I think was a created thing to again, inflate or die. They had to get some inflation into the system. So those were all tools that were used to pull the market up, create the inflation, and it was at that time that they were doing what they were doing with the reverse repo operations to get rates up, and then they started talking rates up, and then from there, short-term rates they did go up, and again, that's just another example of how they step in, and it worked. Sometimes it doesn't work. Sometimes the jawboning doesn't work. In that case, rates were so low. I mean, hell, they were at zero, and then everybody, they were talking about inflation, and rightfully so. I mean, we saw that, and they were able to talk rates up and save it again. So that was part of the tools, one of the tools in the tool chest, if you will, for saving and reinflating the system. So the answer to the question is absolutely 100%. And that kind of goes to the next thing is, like I said, can they save it again? And do they want to? I mean, at some point, I'll go back to this. There's never been a bubble in history that has not come unwound at some point. I mean, it's going to happen. No one can say, there's no chart, there's no bubble in history ever that hasn't completely imploded. The difference here, if you will, I say difference, is that, or the significance of this bubble, let me say it that way, is that no one sees it. It feels normal. It's gone on for so long, people don't realize the bubble environment that we're operating in. Everybody thinks this is a normal world, and it's not. And so the level of complacency, people don't understand. They can't see what's happening. But anyway, I don't know. My point is that, or where I was going with this is, I don't know that it can be saved a fourth time. Maybe it can. I don't know. But I really question it at this point, if it can be saved again.
Do you think central bank digital currency CBDCs are likely to be implemented all over the world?
I don't know exactly what they have planned on the other side of this, but I know that there is a plan. Like I said, I think we're facing, and it sounds a little conspiratorial, but it's easy to see. Once you see it, you see it. I talked about the deflationary forces overhanging the market for the last 20 plus years. I've talked about the need to reinflate when we get to critical points in the market, and how they've done that with debt and manipulation of interest rates. And I think, if I know it, and there are a few other people that know it, that looking at this from this 6 long-term economic cycle perspective, and that we've seen 2 attempted downturns. That's a unique perspective that no one else is looking at. But if I know it, they know it. And I think that, a lot of people, I hear people say, I got a friend that used to say that, the Fed, it couldn't run a popsicle stand. Well, I think he's completely wrong. I think they're masters. They're masters at what they do. They know very well. And when you understand, and you see, how they manipulate rates and debt creation, and you see how it's just masterfully done on time at these cycle bottoms, and they help create the bottoms and extend the cycle. And they, like I said, they've created and extended this entire cycle out of the 02 low. So I'll say all that to say this. I think that they know that the current system is in trouble. What they have planned and how they're going to, what the plan is to steer us out of that on the other side, I don't know. Maybe the CBDC is going to be a thing. Maybe it's not. Maybe it's just noise that we're being told. But here's one thing. I don't think, and there may be a lot of people that would disagree with me on this, but I don't think the dollar is necessarily going anywhere. It is the reserve currency of the world. There's other reasons, political reasons that I won't get into here, but I think, well, let me say this. You may know about some of the, for example, the Great Taking laws. David Webb did a thing about the Great Taking, and I know some lawyers that have looked into that, and they said, look, this is legit. This is real. This is a real risk with this Great Taking. So if you just think with some common sense, if the dollar is going to be useless, then why would they take the assets? It's in dollars. Why would they take the dollar if the dollar is of no value? So I don't have all the answers on that, but I can say this: in the deflationary downturns, particularly the first 3 that I mentioned in the early 1800s or throughout the 1800s and into the early 1900s, the dollar was king, absolute king. The other 2 downturns were not as bad, and it's not because we weren't on a gold-based dollar or anything like that. It's just that there were some other factors that minimized those downturns. We were just in a different overall economic environment. Here, I don't know, but I think the dollar, in a deflationary world, the dollar tends to be king. That's contrary to what everybody's thinking. But will the CBDC have a place? Probably so. That certainly seems like that's the direction we're headed, but I wouldn't necessarily count on it. I don't know. To be quite honest, I'm not sure. But you can bet this: whatever solution, they have a solution. Let me say it that way. They have a solution. They have something. They have a prepackaged solution on the other end of this. I promise you.
Do you think governments would like a digital currency because that way they could track and tax every transaction? The banks could charge you a fee for every transaction as well.
Of course. It would be a great control mechanism. Absolutely, 100%. There's no question about that. And, there's been some legislation passed. Some have minimized it. The Trump administration passed, I forget what it was called the Genius Act. And that kind of paves the way for this electronic digital currency idea. Some have minimized that. I don't know what to think of it. I mean, it is. I look at it at face value. I mean, it seems to pave the way for that. I think we're headed towards some sort of when you look at it in that perspective, it does look like we're headed towards some sort of a digital CDBC type solution on the other end of this. So I don't have all the answers, but that's one data point that points in that direction. Yes, sir.
Do you think this is just part of the war on cash? And what I think about, not tracking me or anything, but just in emergencies. We both live in areas susceptible to windstorms where power lines can be down for days or weeks. Without power, how do you use your digital currency? But cash, on the other hand, is good whether there's power or not.
Exactly. Exactly, and that's one of the reasons why I question it. I'm back and forth. I'm like a ping pong on this. I don't have my mind around it. It's a little bit out of my wheelhouse. I haven't really studied it, but I have been to just even restaurants here where they don't even have menus anymore. They'll hand you an iPad, and then you'll order, and they send the order to the kitchen. And I joked with them one time. I said, "Well, hell, if we had a power outage or the internet was down, you couldn't operate."
Right.
And so,
yeah,
so it doesn't make sense in that perspective, and that's why I'm saying I don't have all the answers to that. It doesn't make sense. Would it be a great control mechanism? Absolutely. But I don't know. I think I have to base my opinion on history, and looking at the history, the dollar tends to be king. So in some shape, form, or fashion, I think the dollar is going to be king if this deflationary downturn bites coming out of this third attempted downturn.
Do you follow Bitcoin and other cryptos?
No, not really. I mean, I think Bitcoin, I can say this just generically speaking, Bitcoin, look, it's just like I think all other asset classes, it's all going to get hit. When this thing turns down, it's going to be a liquidity problem, and it's all going to get hit. So I think Bitcoin is going to go down with everything else.
Are there any sectors bottoming that might be worth looking at?
Yeah, the dollar.
Mm-hmm.
The dollar.
Is the U.S. becoming a safer place to live?
I don't know. I don't know what prompts that question. I would say I don't see any change myself, and where my mind is going is maybe whoever was asking that question was wondering if maybe with the federalizing of the police and D.C. and Trump talking about there's more of that to come, and for the cities, maybe that was the thinking on that. I don't, for one, agree with the federalizing of the police. Do I agree with crime in the cities? Of course not. But I don't see personally. I don't think crime is such a problem in the cities that it's necessitates the federalizing of the police force and using, at least not at this juncture, and using military troops to fight crime. I disagree with that. I just don't see that at all. If that's kind of the spirit behind the question. Now, let's take this another angle, another direction. If we see a decline like I'm talking about, and let's put on our bearish hats and really be bearish. If we see the kind of decline with this 6 long-term economic cycle that was seen with the first 3, imagine if we were put back into a situation like everybody can relate to. They can't relate to the first 2 cycles, but they can relate to the Great Depression. Imagine if we saw a decline in the market of 90%, 89%, like we saw with the Great Depression, with the 29 top and the decline into the 32 low. Think about COVID. Think about the problems that were created, that stem from COVID with the supply chain shortages and all that sort of thing. And then think about a 90% decline in the market and what that would do to people's retirements and savings, and I could see how that would totally cripple and shut down the U.S. economy, or the U.S. as a whole, period. And in that kind of environment, I could see how crime could go off the rails. Absolutely off the rails, because if we had that sort of a scenario, I don't think there'd be groceries in the stores or gas at the pumps or, medicine at the pharmacies. So I could see an extreme scenario where crime could get pretty out of hand. But based on I think obviously the looting and desperate people. I'm not predicting that. That's not what I'm saying. I'm just, trying to answer the question. But if we saw something like that, I do think that sort of thing is a risk, particularly in the larger cities, 100%.
As things hit the fan, where do you think the safest places will be to live?
I don't know. I've thought about that actually, and I don't have that answer. I don't claim to have that answer, but my hunch is anywhere where you don't have a lot of people. I watched a show one time. It's been years ago. I don't remember the name of it. I think it was done by the History Channel. And you're making me think about this. In my comments about your other question about crime made me think about this. But it was a prepper family, and things hit the fan, and they retreated to their location, and it took about 3 days or so. And of course, this is a movie, but there is, some legitimacy behind it, a point in it. And then as people got, at first people didn't think much about it, and, it's just an inconvenience. But after, a short period of time, people become desperate, and the cities were chaotic, and it was, pretty bad. There was a movie done, I think it was in 23, Leave the World Behind, and it was about a power outage and the same sort of thing. And there's more to the story than just that, but anyway, same thing. The cities got chaotic. So my thinking is, and I'm not saying I'm right because I don't know, but I would say in a smaller area or a very rural area would probably be, I think you'd probably be better off there than in a larger city in a Armageddon scenario like that.
Where can our listeners subscribe to Cycles, News, and Views?
Cyclesman.com.
Tim, thank you so much for being on This Week in Money.
Thank you for having me.
My guest has been Tim Cyclesman Wood, editor of Cycles, News, and Views on cyclesman.com. He was speaking to us from Alabama. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and Tim Cyclesman Wood. And thank you for listening. If you have any questions for the show or for any of our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.